So good afternoon and welcome everybody to our final panel session of the day. Time is flying by. So it's panel 4 and we're looking at DeFi. Is it a geek's paradise or is it the future of finance? You might have thought the last panel on regulation was the geek's paradise, but apparently it's this one. So stick around if you're a geek, stick around if you're interested in the future of finance. We've got a great panel here. Joyce Lai is with us, beaming in from another event where there's a few technical hitches, but she's made it. So we're very happy to have her. She's going to guide us through this session with a fabulous lineup of speakers who are all really expert in the industry. So Joyce, I'm now going to hand it to you without further ado to introduce your panelists.
Okay, great. Thank you so much, Helen. So I'm actually going to have each of the panelists do a quick introduction of not only themselves, but also their company. We'll try to keep it short to about, one sentence for each. So here on my screen, I have Richard first. So Richard Crook, would you please give a quick intro about yourself and also for your company?
No problem. So Richard Crook, I founded Lab 577. We sit at the nexus of emerging tech and financial services. So we help clients very much focused on digital assets right now. We brought to market digital asset shared ledger, DASL. It's a complete solution for issuance, trading, settlement around specifically digital security. So our clients are mostly regulated in the securities or capital market space. And that's what we've been focused on.
Thank you very much. And Ankush, Jain, would you please give yourself a brief introduction for yourself and the company?
Sure. So my name is Ankush. I'm the Chief Investment Officer and co-founder of Aaro Capital, which is a London-based business established in 2018. I have a background in fund of funds, which is what we're doing. So we're running a fund of funds focused purely on blockchain and crypto assets. And I'm very happy to be here. Looking forward to taking part.
Perfect. Next, we have Ajit Tripathi, my ex-colleague from Consensus. Very happy to see you here. What do you do now? And I see you work at Aave.
Yeah, so Aave is one of the world's best-known DeFi protocols. Aave enables users to supply liquidity, deposit crypto assets, and earn a yield on those, or borrow liquidity from the Aave protocol. It's fully decentralized and autonomous. And I'm focusing on the ARC product for Aave, which is our permission solution for institutional and corporate users.
Perfect, thank you. And last but certainly not least, we have John Wu from Avalanche. John, would you please introduce yourself and also Avalanche or Ava Labs?
Sure, happy to. Hi, hello, good afternoon. My name is John Wu. I am president of Ava Labs, and Ava Labs, the team behind the protocol Avalanche. Avalanche is a first layer, Ethereum compatible, has certain features that are quite attractive, especially for DeFi. That is high TPS, a lot of scale, low cost, and instant finality. So happy to be here and talk about DeFi.
Perfect. Great. So we have a very good mix of people from different perspectives here. We have people who are building the software, and we have people who are doing the investments, and people who have also done different things in their previous careers. So, one thing I wanted to hear from you guys about is when we talk about institutions coming to DeFi, right? I think institution is a very broad term in the finance space. It could mean anything from hedge funds to specific types of hedge funds, to investment banks, endowments, anything, right? So I'd love to hear you guys, talk about what institution means in the DeFi space right now, really to get at, who is even looking at the DeFi space right now from the, business side.
Yeah, so if I may take this,
yeah,
everyone, right? So I mean, the only way we know who is looking at DeFi is we get a lot of inbound queries on LinkedIn, Telegram, you name it, right? So we even have the tech people from a very large bank on our Discord channel asking questions. So if you go back to the beginning of last year, the early adopters were crypto natives, people, Ethereum devs and so on. And then came the whales, high net worth individuals with significant crypto exposure. Then family offices, proprietary money, and hedge funds started coming in towards September and October, and started deploying experimental liquidity in Aave, and and other DeFi protocols that's grown quite substantially. And what's kind of really missing is client money is still quite limited in terms of when you look at asset managers, traditional asset managers, retail, fintechs, and so on. That's still a bit limited, but in terms of exposure to DeFi, either through crypto capital markets or through direct exposure to sort of using the protocols hands-on, we're seeing a lot of proprietary capital coming into DeFi now. I think what's missing is, and we do a lot of work around education. So we do a lot of discussions with sort of capital markets institutions, FMI, banks, some of the biggest banks and investment banks about how they can potentially use DeFi in the future. So in different ways, pretty much everyone is there. I think what's really interesting, and we can cover this later, is the involvement of institutions and governance, but we'll talk about that.
And what about you, John? What are you seeing in terms of who's coming to you to ask about how Avalanche works? Can you build things for me? Who are you talking to, if you can share?
So from an institutional perspective, I think you're asking, correct, Joyce? So from an institutional perspective, there are two groups, basically. The crypto native funds that are in the Avalanche ecosystem doing things, yield farming, doing whatever, crypto native people would do. They're very much crypto native to begin with. There's a whole new crop of what I call traditional institutional funds, whether it's hedge funds or private equity. They are ready to tiptoe in as individuals. The principals of these firms have played in the DeFi sandbox, if you will. But as a firm, they are holding back a little bit because of regulation and how to really assess risk for their LPs. But they are there now with inquiries, learning with full intention of participating, as opposed to 2017, where if you walked around where you and Ajit were in the consensus conferences, it was more about, hey, I'm here for education only. Now it's about learning for intent to do something.
That's really interesting, John. So from a person who's actually managing a fund, right, Ankush, and also Richard, if you can chime in here. So what types of questions are you hearing from the traditional institutions that you might be speaking with who are trying to get educated? Ankush, you might be muted right now. Richard, do you want to chime in while Ankush is?
Yeah, just while Ankush sorts his audio out, do cut across me, Ankush, when you finally work it. But from our perspective, we've seen a lot of these banks come together early in this process. They recognize the risk and threat to their own business models. It doesn't come as a shock that these companies have been now here for half a decade. They've been experimenting for a long time on different blockchain technologies, be it Ripple, Ethereum, Corda. From our perspective, we work with these clients. They are continuing to point out the obvious requirements that are out there, where you're balancing off transparency with privacy. You're balancing anonymity with the need to know your clients, the AML and CTF issues, and those requirements have always been known. And one of the reasons we work with Corda so closely is those original banks that set up Corda recognized that they needed a blockchain that would be a finance blockchain. What you're seeing now over a good half decade has been a general convergence as each crypto network has recognized, or blockchain network has recognized, that they need to come together, converge on those requirements and deliver. So from my perspective, this is a multi-decade play. It takes time for the engineers to get to those requirements. And if you look at ETH 2.0, it's not dissimilar to the original functional requirements of Corda. So what we're actually seeing here is the classic tech convergence over time, where just as the phone in your pocket, doesn't matter if it's Apple or Android, it all looks very similar now after a couple of decades. We're going to see the same thing over in the technology space. I think lifting above that, actually, the tech becomes less and less important. People become less and less interested in how the internet works as soon as they bought a book over it. And actually, what we are now starting to see is a much more interest at a business level. Just as John was pointing out, the inquiries now are at a business level, not at a tech level. And actually, people are starting to ask questions about how they can make money over this as we start to build what we would describe as an internet of value rather than an internet of information, which is what we've been working on for the last 20 years.
And Ankush, would you like to add to that?
I think you'd love to.
Yeah,
Ankush.
probably pleaded the fifth over there.
Yeah, Ankush, and unfortunately, we can't hear you right now. I don't know if other people can hear him.
No, unfortunately.
Yeah, so I'll probably start because it's very hard for me to not speak on this topic. So Richard and I have disagreed on this for a very long time. So I think what we are seeing with DeFi is not building to sort of requirements of legacy institutions, but building whole new rails, from the ground up. So right, if you look at how regulation works today, for example, then I used to work for PwC, and regulators rely on a lot of paperwork, a lot of audits. So all of these legacy, compliance departments rely on a ton of spreadsheets, risk. I mean, banking runs on Excel, right? And that's unsustainable. What that does is it locks a lot of people out of financial systems because, everything is so expensive, right? So the banks are unable to serve the marginal consumer because the cost to income ratio of banks, even in Europe, right, particularly in Europe, is quite unsustainable. We're looking at 70% cost to income. And all of that most of that comes from just terrible legacy processes and systems. So I think with DeFi, we're looking to start to build software and infrastructure that hopefully will provide far more efficient on-chain, transparent, and automated rails for market for the future. I agree with Richard that this stuff takes time. There is always some irrational exuberance in people expecting everything will change in 2 weeks or in 2 years. It won't. It takes a very long time to change. Swift has been around 44 years. It takes a very long time to change, financial market infrastructure and so on. But I think we are Web3 is starting to do that, right? So, but it's not being written to requirements. I think we're starting from scratch.
Yeah, so it's definitely a big theme, even at the different events that I am going to and in our hearings. It seems like there are very key things, for example, like KYC, and still custody issues to be sorted out. I guess if you're a person trying to figure out timing and when this next wave is coming in, and you're looking for a signal, right? John, like what would be like the very top 1 or 2 things that you would look for to happen for the next really big wave of money to come in for DeFi?
Well, money is going to come in for DeFi in 2 ways. One is more and more of these traditional funds now have hired crypto experts to help them invest. So money is going to come in when these companies, these funds are comfortable with KYC, AML, and willing to invest directly, as opposed to be an LP in someone else's fund and let them take all the risks. So that would be the first indication. And the second indication is for teams and projects that are building great products for the institution, kind of like Ajit's Aave Arc, when we see liquidity pools in there start to get really populated, that's another indication. But the first indication will be when these funds start direct investing, as opposed to putting their money in via the principal or through other more called crypto native funds and letting them take the risk.
And hope my audio is working now. There we go. So if
There we go.
I might
Perfect.
perfect. So if I might just add to that, John, you made a very good point about people allocating the capital to other funds first before entering directly. And I think even before reaching that stage where investors can directly invest, the funds on offer currently are still very dispersed in terms of quality. Some funds are very good. They're up there in terms of institutional best practices. Other funds aren't so good, and then particularly operationally. So when it comes to governance, custody, valuations, even having the liquidity to take on a large amount of capital, there's still quite a long way to go. So I think the first step would be to get crypto funds up to the standard of institutional investors, so they can take a first step in and become comfortable with investment, and then move over to direct investments and directly getting involved with DeFi and the risks and the rewards that come along with it.
Thank you. And for all of you here who have very distinguished previous careers before that has happened in the past, how would you explain this and how would you compare it? Maybe John, you can take the first step.
So I think Joyce kind of cut out, but I think the question was.
Yeah, can you hear me now?
Yes. I think your question was,
so
can you compare the evolution of institutional adoption in DeFi versus previous generations of tech adoption and fintech, so to speak?
Yes, that's perfect.
Okay, great. So actually, I think Richard answered this question earlier. In the first generation of fintech, of internet and Web 2.0, you saw innovative things such as PayPal with wallets and then getting people comfortable with transacting online in e-commerce fashion. And then you have the actual companies like Amazon create wallets, et cetera, et cetera. But then the innovation afterwards was really not technology, and it was more about business model and reg tech. You had companies like Square decide that they can figure out a way in a compliant way, because they're not technically a bank and don't have the same restrictions, to all of a sudden lend merchants. And then basically because they have the point of sale contact. And now you've gone to another level, like where firms like Affirm, where they're actually lending on the transaction itself to consumers. So the same thing will happen in DeFi. First, you need the technology to be there, and you need innovative firms and innovative protocols like Avalanche and Aave to give people a taste. But once that is established, you're going to see business innovation and the ability, and whoever's good at acquiring customers or institutions and figuring out a way to keep them in there, either through constant innovation or through other clever mechanisms.
Ajit, would you like to add on to that?
Yeah, absolutely. So I think one of the things is, right, so there is a narrative going around that DeFi is somehow competing with banks or so on. That's not the case, right? So DeFi is software for market infrastructure, and look, I mean, what's going on is kind of this transition from Web 2 to Web 3. And as part of that, right, so DeFi is creating a whole bunch of primitives that are being used in now NFTs, decentralized social media, and crypto gaming. So there is this whole Web3 economy that's starting to take shape. And 3 years ago, I wrote an article saying, okay, it's great we have all these blockchains. It's great we have all these cryptocurrencies, but who's actually using them? And for Web3, for all of this to work, we need a Web3 economy. Now that Web3 economy is finally starting to take shape with all of these applications that people are actually using. And it's kind of a digitally native, right? Natively digital economy. So now that requires a different type of infrastructure, and that's going to continue to grow. So the traditional Swift rails and all of the infrastructure that's out there in the current system is actually simply not fit for purpose. So Web3 is kind of being created right now, and DeFi is serving Web3. But then this infrastructure will then become very useful across the board and in financial systems, and intermediaries will use these, right? So if you look at the way Arc is being built, So financial intermediaries and regulated intermediaries will provide compliance as a service on Arc, right? So all the KYC, transaction monitoring, all of that stuff is not something that software companies do, right? So Aave is a tech company, and we don't. That's not what we do. We build software, and then there is a role for intermediaries where it makes sense, in markets where that the only way to enable access to consumers is through intermediaries as of today for whatever reasons. Then intermediaries come in and they plug into this infrastructure and they provide access to DeFi yields and other sort of, whether it's Uniswap or Maker or Aave or whoever, all of the DeFi infrastructure access will be enabled by intermediaries. And so there is a role for all of those. But then the infrastructure becomes far more transparent and automated, and it's on chain, and that sort of brings utility to all of the blockchains, right? So we're doing something very, very interesting with Avalanche right now. And so the types of, and then consumers will be able to choose whether they want to use Aave on this layer 1 on Ethereum or on Avalanche or wherever, and based on their requirements, they will be able to use Web3 infrastructure on chains that make the best sense for them. And so there is all sorts of, there's a technological transition, there's a cross-chain idea that's happening, and institutions, obviously have different parameters based on who you talk to. So all of that innovation is happening in a very creative, very, iterative way, and I think it's going to be phenomenal. It's not something that can happen by design. There is just an incredible amount of creativity in this space.
Right. So I do think that in the future, DeFi and CeFi and maybe traditional Fi, it's just going to be Fi. It's just all going to be finance. As that transition is happening, I'm taking a question from the audience here. Scalability seems to be an important component of DeFi, which is definitely true. Can some of you speak to the current bottleneck that we have in terms of transactions per block and just speed, right? What is it that people are seeing right now with that particular problem, and how are your companies or your portfolio companies solving these problems? Richard, do you want to take a first answer? Yeah, and I'm sure John will have something to add as well.
For me, the scalability question was always one of the cornerstones of the functional requirements, which is you're not going to build a financial system on a system that won't let you scale horizontally. And if you look again at what's now coming through in the second or third versions of these leading blockchains called Ethereum, you see that scalability is less of an issue. Just as the early days of the internet, we'd have never been able to roll out things like iPlayer and Netflix, and even when they were rolled out, the internet creaked as we scrabbled to catch up. What we'll see is the normal arms race between the users who are continuing to want to use more and more of these leading blockchains, and also the engineers behind them creating improvements. To your point around DeFi conversion with CeFi, it's much more interesting to get up against the business layer. And I tend to use the last line of Animal Farm, where the creatures looked from pig to man and back from man to pig and could not see the difference. It doesn't matter whether you think the banks are pigs or men, or whether you think the crypto is pigs or men. The two are converging at a very rapid rate. What makes it interesting is the banks and the financial institutions are shackled by the tsunami of regulation that came through in 2008 to protect the consumer and the retail investor and the real economy that they threatened. On the other side, the crypto space or DeFi space in this context is running at breakneck speed and is creating a white heat of innovation, which is very welcome actually in the finance space. But as you bring these two together, Ajit and I always disagree on this. The rule book isn't changing just to meet the technical constraints. The technology has to meet the rule book. And that means that actually, when we look at that Animal Farm timeline and how quickly, it's no surprise that the 3 of the 20 agenda items at the G7 last June were aimed squarely at this new crypto finance space. So you're going to have to grow up and gain that rule book and understand it. And that's exactly what Ajit's doing with things like the institutional product coming out of Aave. They're working hard to work out how they can meet those requirements. And most of those requirements aren't software. They are codes of conduct, they are risk, they are compliance. It's not a difficult book to follow. You just have to follow it.
Yeah, so I think I'm glad this is not a debate. It would have been a little bit too spicy. So I think, see, I think technology always moves first, right? I mean, at some point, because that's what engineers do, they build and they build quickly. So we've seen that with the internet. Before we had credit cards, and we had SSL. People were already buying and selling stuff on the internet. Then technology evolves, and you start to scale e-commerce, because now you have far more secure ways of transacting on the internet. So and then markets follow. Markets identify that there is new tech, and then they really get excited about it, right? Like right now with DeFi and NFTs and all of that stuff. And then regulation and law adopt to the fact that there is new technology. So I think in all of our engagement with regulators, central banks, policy institutions, what we've seen is the acknowledgement that the regulatory infrastructure and everything, policies we have built are probably fit for infrastructure that was there 40 years ago, like Swift. No particular offense to Swift. And now that there is new technology, maybe there is better ways to look at DeFi, right? Everything is on the internet. If you go to Dune Analytics, or you go to Nansen or so on, you can see the level of detail that you could never get from a bank, right? And so I think this type of infrastructure with this level of transparency, the question is, what can we do? And that's a question for reg tech and policy institutions as much as for anyone else. Now, just one thing on that. So what are the challenges we need to solve for? I think we need to solve for identity and reputation, right? Identity is the basis of all of financial regulation. Then there is, and once you have identity and reputation, you can add recourse, right? Which is, if something goes wrong, what happens? You can add kill switches. So that requires collaboration between innovators and policy institutions as much, right? People have been working on-chain KYC for now 6 years. It's one of the oldest ideas I've heard in this space, but that doesn't seem to take off because of the fact that rules are written in a way that Deutsche Bank has to has 30 separate systems for KYC people. I mean, this is just simply not going to work. So now that we have new tech, I mean, it's time for policy institutions to recognize that there is a far more efficient way of running the system, and maybe we can use on-chain identity and all of the information and analytics we have available. So it's a two-way street, right? Maybe we need innovation on the other side as well.
Thank you very much. I guess just to go back to the scalability question very quickly and close that out is, what are you guys seeing? Are you guys seeing teams that are specifically addressing the scalability issue or products? Maybe Ankush and John can speak to that.
Sure. I mean, I think we talked about how important scalability is to have an economy as opposed to just ecosystems of developers and users. The first generation of crypto was just Bitcoin, taught us the internet of value. Second generation was Ethereum, smart contract, programmability. That started ecosystems, but you cannot have an economy unless you have transactions that can be done at a fair price, reasonable price, and relatively quickly and scalable. That's, the entire purpose of, first layer protocols in this third generation, like Avalanche and like some others. Others are also trying to solve it with layer twos. We can debate which one's better, what's the ultimate solution. But the point is, there were ecosystems that needed to become economies. And Avalanche and other layer ones solve that for now to make things so that you can do things faster, finality, as well as lower prices so people can transact.
Yeah, so maybe I want to stop here because we're now using terms like layer 1 and layer 2, and I'm not sure if the audience all know exactly what that means. Can you just very simply explain what are all these numbered layers in this world that we live in?
A layer 1 is like Ethereum in the sense that it is its own consensus protocol. Layer 2s usually are side chains or things that are built off of something else, And usually they batch things and have more of a centralized way to validate, well, actually to secure, to actually do things, and then the security and validation is ultimately printed as a batch onto the first layer. Great,
thank you. And Ankush, what are you seeing in terms of the teams that you guys are investing in, the entrepreneurs that you're talking to? What types of things are they building to address some of the issues that need to be solved in order for like scalability in the economy to be a reality, like John mentioned?
So, I mean, there are quite a few different types of funds that focus on DeFi and specifically scalability. A few years ago, much of the focus was on Ethereum and the Ethereum ecosystem. But as we know, as usage has increased, now it's becoming difficult. You know, fees are rising higher, scalability is becoming a bit more of an issue. So now we're seeing more investments into things like Solana, like protocols that John mentioned as well, which are much cheaper, much quicker to transact on, and also developing like the wider ecosystem within those specific players. So that's really helping in terms of making DeFi a bit more accessible and a bit more friendly. But another important thing to note is that when looking at funds, one side is the long-term DeFi usage play, which is all about scalability, making things much more accessible, much more robust for retail and institutional investors. But then you also have funds which focus purely on just generating yield, and they don't really care too much about how high the fees are going to be, how quickly you can transact on things. It's more about extracting higher yields than you can in the traditional world, using new financial products. So in the traditional world, it's all about, you can get 0.5, 1%, maybe 1.5% if you're lucky, through investing in bonds or T-bills or other asset classes. Equity markets are at all-time highs. Property is, barely offering any diversification benefit. In the DeFi space, you can take practically no market risk, and you can generate yields of, it could be upwards of hundreds of percent if you want to take on that risk, or as low as 5 or 10% if you want a very low risk strategy. So I think scalability is very important. A lot of funds are focusing on scalability. There's teams developing solutions and protocols and ecosystems that deal with scalability. But then there are also a lot of funds that just want to extract the yield and don't really mind so much as long as there's a good return on offer.
Thank you. So we have one more question from the audience that I'm going to have Richard answer before we move on to my final question for each of you. The question for Richard is, I guess, a reference to a Animal Farm timeline that he's talked about in the past. Richard, could you very quickly just explain what it was that you were talking about and where are we on this timeline?
The Animal Farm line that I referred to earlier was the last line of Animal Farm, which is the creatures look from man to pig and back from pig to man, but could not see the difference. It's the convergence of crypto with finance that we're now seeing at a rapid rate, as I described both sides, as they converge. So in terms of the speed at which that is occurring, I think we are starting to see a slight level of blockage as the regulators, starting with the G7 regulators, have now got their eyes squarely focused on the crypto space. And you'll see that slowly working through. So the natural progression from a G7 summit is then usually months of committees rolling down through the finance ministers into the central banks, into the regulators of the respective countries, usually ending up as a Dear CEO letter. I'm surprised you haven't got one yet, Ave, or Ajit on your side. But the financial institutions right now in the US are probably the ones that are staring at their Dear CEO letter, but while at the same time having a conversation with Ankush to try and say, well, how do we make ourselves compliant so that we don't break what's in the CEO letter? But it's fast moving, and for the regulator, it's really troubling. They've had 30 years of database technology, and therefore they've built most of the regulatory rulebook around databases. So if you're a stock exchange or any kind of market infrastructure, you're based around a database, which is really easy. There's a single throat to choke. the London Stock Exchange, the NASDAQ, you can go after them. But if you're looking at DeFi, the analogy is it's the sea, it's an ocean. You don't regulate the ocean, you regulate the ports. And I think what you'll probably see is the regulators engaging in an actually pretty mature conversation. The regulators we speak to on a regular basis are not blind and they're not stupid. They are usually very aware of what's going on, and they are trying, as we always ask, to deliver good regulation later rather than early bad regulation early. And that's really, in terms of the timeline with Animal Farm, is this convergence is happening. No one doubts it. There is no DeFi or CeFi. There is just finance. What we're trying to work out is how do you regulate it when there isn't a central throat to choke.
Thank you.
I feel very provoked. Thank you, Richard. So I think we have to move away from the mindset of ham and sausage and somehow making the sausage inside a bank and turning pig into man that way and man to pig and whatnot, or choking throats. I think the regulation isn't necessarily about choking throats. It's about delivering. It has twin objectives, right? Hopefully, innovation is one of the objectives as well. And you're right that whenever there is innovation at this speed, then some things do go wrong. And when you're building a jumbo jet, then sometimes but people don't fly if you never build the jumbo jets, and people never fly if you don't build the internet. So I think the hard part for regulators and policymakers is how do you balance the innovation objective with the supervision objective, and that's not easy. So I have all my so we speak to a lot of policy institutions, regulators, and central banks and this and that. It's part of what we do strategically. But I think we sort of probably need to move away from choking throats to actually figuring out how we collaborate and how we innovate, not just in the it's not regulators versus innovators. It's actually sort of figuring out if there is a better future for everyone, right? I think if we can move to that, then we'll have a great outcome for everybody.
Yeah, certainly all really difficult. I'm a lawyer by training, so I 100% appreciate the hard work that you guys are all putting in here. So I think we're getting very close to time. I have one last question for each of you, kind of coming from the other angle, and I'd love to have each of you give a very short response to that, which is as the traditional CeFi people are coming in, it's going to change the way DeFi works right now. So if you were talking to someone who's crypto native, who's looking at it from the other perspective, when they see this herd coming, if you want to tell them, hey, you need to look out, this is what's going to happen, in no more than 2 sentences, what would you tell them as your advice? We'll start with Richard.
So it doesn't matter if you're in the audience coming in from a financial institution or if you're a crypto native, you're about to watch a tsunami of regulation coming in against crypto, onto crypto, and lift your head above that noise as it comes through. Don't get weighed down by it. It's just a natural progression. Actually recognize that we just spent the last 10 years issuing pink debit cards and putting lipstick on the pig of the financial institutions, of the financial services banks. We're now into the next 10 years of actually changing the back end of finance, and that's what DeFi is really starting.
I agree with.
Okay, so party's not over. Party's just getting started. Ajit?
Yeah, yes. I mean, look, so, try not to think too long term. This space moves really fast and it goes up and down, right? It's by definition, it's so early and such a space of rapid innovation that, and it's very different from, so Richard and I have never agreed on Coda, for example, because I came from Goldman and we were building SecDB in a very very in the same way that DeFi is being built, right? And SecDB is the best, by far the best risk system on Wall Street by a long, long mile. And the reason it's so good is because it was built by evolution, right? So people were responding and reacting and creating. And as a result, we ended up with 3 million plus lines of code that were never used. And DeFi will be the same. So DeFi is being built in the same way as SecDB at Goldman. And it's really a creative and innovative process, right? If you try to do it by intelligent design and say, oh, what are our requirements going to be in 5 to 10 years? And therefore, what should the regulation be in 5 to 10 years? Then that's not going to fly. So I think we all have to kind of, so my advice, play with this stuff, right? Get a MetaMask wallet, get some, crypto in your wallet, and actually experience Aave. Just use it. I mean, how hard is that? Use Uniswap, use Aave, use some of the other, secure DeFi protocols on different blockchains. See what you like, and that's the only way to learn this stuff. And participate in governance.
Thank you, Ajit. So I'm keeping an eye on time, but I want to make sure the others have a chance to add here. So I'm going to be very strict on this sentence limit here. Ankush, what do you say to the crypto native people as the institution herd is coming in?
I think it's a natural evolution. It's inevitable. It's going to happen in some shape or form, whether it's going to be completely regulated or unregulated, or there's going to be a split between the two. There are plenty of return opportunities available, whether you invest directly, whether you go with the fund, whether you try and create something a bit more complex and a bit more native to the space. But it's a great opportunity. So I don't think it's too early. It's not too late. As with any market, there are return opportunities. There are also risks, and it's just about weighing things up. So even if it's a very small amount of a portfolio, or if you want to be a bit more ambitious and size it a bit more, there are plenty of opportunities, and I think it makes sense for anyone really.
Thank you. And very last but not least, closing remarks, John Woo.
Well, for the crypto native person, I would encourage them to continue to innovate, because even if institutions come flooding in, their first instinct is going to be to replicate existing products and services. There are going to be things native to crypto that they will not be thinking of because they're not culturally there yet, or they don't have the ethos. So continue to innovate, and you can always have great things that everyone will want to use.
That's perfect. Thank you so much, everybody. I think we're at time. And my name is Joyce Lai. Really happy to have been here with all of you to catch up. And thank you very much.
Thank you.
Thank you.
Thank you so much, Joyce, and to the rest of the panel for your insightful thoughts. And thank you to all of our panels. This wraps up our agenda for today. Thanks, everyone, for joining us. I can see that a good number of you have hung around for the whole session. So hopefully that means that there was some interesting discussion taking place. Hang around afterwards, if you will. The speed networking and lounge will remain open if you want to connect with some of the speakers or your fellow delegates. If you enjoyed the content today, Coinscrum at coinscrum.com, we publish weekly interviews along similar lines discussing what's going on within this industry, especially around this new wave of institutional interest. So please feel free to check that out every week. Also, thank you to our sponsors, CMS, BSO, Crypto Finance, and Reactive for your support today. Please check those guys out as well, because they're offering excellent services into the industry. And also, thanks to our event partners, firstly, Context 365. If you haven't already, you should be receiving an invite to access their platform, so you can log in there, especially if you're a fund or a capital allocator looking to connect. It's a great platform for doing that. The rest of you can join to stay connected with your fellow delegates over the next 4 weeks as well. And finally, thanks to our other event partners at GDF, Inatba, and Crypto UK. Coinscrum grew out of a raw meetup community 9 years ago. So we've seen the importance of community, and for everyone working within the industry to join together. We actually, members of that community back in 2014, launched the first UK industry association. It was very difficult to get members back then because Bitcoin and crypto was still a very dirty word, and financial incumbents were definitely not interested in supporting that. The landscape's changed a lot, and it's really important to support these initiatives. So please do so. They're doing a great job, and it's important for you and for the industry as a whole to get their voice heard, especially as regulators come to the table. So with that, I'll sign off. Thanks again for joining us. Hope you enjoyed it, and please hang around to do some networking, and we'll see you again soon.